Let's get started with mortgage loan scenario, problems and solutions. Loan scenario problem number 1, inconsistent income with significant deductions on tax returns. We've all seen this before. Let's get started. Borrower name, Sarah V. Situation is this. Sarah is a self-employed graphic designer who wants to purchase her first home. She has an inconsistent income due to the nature of her freelance work, and her tax returns show significant deductions, which you're going to see often with many borrowers that you might have. She's looking to purchase a property for $300,000 with a down payment of 20% and needs a loan for the remaining $240,000. Her debt to income ratio, or DTI, needs to be within 43% to qualify for the loan in this case, and her monthly debt obligations, excluding the mortgage, total $600. She believes her average monthly income is around $6,000, but her tax returns show a lower qualifying income due to her deductions. Our task is to determine if Sarah qualifies for the loan based on her income and DTI. For the math problem, we're going to be calculating Sarah's DTI first. Number 1, we're going to determine the monthly mortgage payment. Using a 30-year fixed loan with an interest rate of 6%, the monthly principal and interest payment for $240,000 is calculated by using the formula for a fixed mortgage, or you can simply input that into a mortgage calculator, or go on Google and enter mortgage calculator and then simply input 30-year fixed, 6%, and $240,000 for the loan amount. And you're going to get a monthly principal and interest payment that equals $1,439. Then you're going to add the property taxes and the insurance. In this case, we're going to assume her annual property taxes are $3,600 and her annual homeowner's insurance is $1,200. If we divide those two amounts by 12, we're going to get the monthly property tax equal to $300, which will be her monthly property tax. And we're going to do the same exact thing for her homeowner's insurance. We're going to divide by 12 and we're going to get $100. Now, these two numbers are very important because we have to do everything on a monthly basis so that we get the right numbers and the right calculation. Right now, we're going to have a total monthly housing payment that equals $1,439 plus the $300 for the property taxes plus $100 for the insurance, and we're going to get a total of $1,839. Now we're going to calculate the total monthly debt obligations. So her monthly debts, excluding her mortgage, are $600. So we're going to take the total monthly obligations and calculate that by adding the $600 that she has, excluding the mortgage, plus the PITI, which was the principal, interest, taxes, and insurance we just calculated, of $1,839. And we're going to get a total of $2,439. Now, if we determine the qualifying income from her tax returns, we're going to see that after reviewing Sarah's tax returns, her qualifying income after deductions averages about $5,500 per month. Before we go over the solution, I want to talk about what a bank statement loan is. Well, some banks or lenders have a loan program that allows borrowers to qualify based on a percentage of the deposits they have in their personal or business bank account. This is known as a bank statement loan. Sometimes 50% of deposits are used, while other times 90% of total deposits over a 12-month or 24-month period is used. It just depends on the lender and if we're using personal bank statements or business bank statements, okay? Because there are some lenders that allow you to use either or of the other, and then sometimes they'll let you use 12 months deposits or 24 months deposits, while there are a few other banks that might be not non-qualifying mortgages, which will allow 6 months or even 3 months bank statements, believe it or not. Now, I want you to pause the course lecture and try to find the solution. If you're not sure, you can simply continue with the course lecture, but I still want you to think of all possible solutions and try to figure it out on your own. If you can't, then simply continue on to the next lecture and let's see how the instructor did it. Loan scenario solution. To get Sarah's loan approved, we're going to use the following strategies. Number one, alternative income documentation. Sarah provided 12 months bank statements that showed her average gross deposits were $7,200 per month. Using a bank statement program, we were able to use this higher figure to calculate her income. Right now, we're going to recalculate the DTI. Remember, we used the DTI based off her income that was on her tax returns, but now we're going to use the bank statement deposits, okay? And in this case, it's going to be, the DTI is going to be calculated by dividing 2,439 by $7,200, which is her new income, times 100, so we get a percentage, and this equals approximately 33.9%. And with a 33.9% DTI, Sarah now qualifies for this loan. Number two, the loan program adjustment. We switched to a non-QM or non-qualified mortgage loan program that allows for alternative income documentation. Although the interest rate was slightly higher at 6.5%, Sarah was comfortable with the revised payment. Number three, borrower education. We explained to Sarah how keeping thorough income records and reducing discretionary deductions in future tax filings can improve her loan eligibility for future refinances or purchases. So we basically told her that if she was able to provide her actual income on her tax returns and provide any deductions that were necessary only to be able to qualify with the highest potential income, she would be able to refinance in the future to a lower interest rate or even purchase other homes if she wanted to. How the loan was closed. By leveraging a bank statement loan program, we demonstrated that Sarah's actual income supported her ability to repay the loan, even though her tax returns painted a different picture. The key was understanding her financial situation holistically and aligning her needs with a suitable loan product. Sarah's loan was approved and she closed on her first home successfully. She was thrilled to achieve her goal and appreciative of the personalized approach we took to solve her unique challenges. Now, this is a perfect example of how to solve problems that seem impossible to solve, but if you take a different approach and by using different loan programs, you're able to use these valuable tools to get loans, to go forward and get approved.